Ladies and gentlemen, good afternoon. Welcome to this seventh webinar in this Banking and Financial Services Awareness Month. My name is Silva Sheine. I'm happy to be your moderator today. And in our slogan, as you're aware, is your money can be money smart. Sente yo esobola. That's a very exciting slogan that we're looking at today throughout the course. So feel free to get in touch with us on our Twitter handle, and you can visit the web portal, which is www.yourmoneycan.or.ug. On behalf of the Institute of Banking and Financial Services, I wish to welcome you to this seventh webinar, and I wish to give a vote of thanks. Kudos to our strategic partners that have made this possible, and that is Bank of Uganda, Uganda Bankers Association, the Financial Sector Deepening Uganda, FSDU, Uganda Insurers Association, and Summit Consulting Limited. Thank you so much, our strategic partners. Without you, this would not have been possible. A big thank you to the platinum sponsors, and that is Bank of Africa, Uganda. Thank you so much, Bank of Africa, for sponsoring this. We have our other sponsors, EcoBank, Equity Bank, KCB Bank, Absa Bank, Uganda, EFC Uganda, Finca Uganda, Equity Bank, Pride Microfinance, Ugaford Microfinance, Stanbic Bank, Opportunity Bank, Summit Consulting Limited, Bank of Baroda, Bank of India, BRAC Uganda Bank, Housing Finance Bank, and Centenary Bank. Thank you so much for giving this all efforts you did in sponsoring the Financial Services Awareness Month. In the past, we've had 6 of this kind, and as you're aware, this is the 7th. In the 7th webinar, we're going to talk about credit facilities, their terms and conditions. So we need to dive in a little bit to know about the credit. What are the terms and conditions? What are the factors we need to look at as we're selecting credit? And what would it be from both the supplier and the provider of financial solutions? But in the past, we've had webinars on becoming better at savings. That was our very first webinar. Becoming good at personal financial management, savings as a tool of entrepreneurship, money and family. And the very first one, in the second, we had how to strike a balance between savings and investment. And then we also had traditional modes of investment against the contemporary options. These have been a series of the webinars, and we believe they've been value adding to the banking and financial services community. And we welcome you again to participate in this. A focus on today's session, we are looking at the credit facilities, their terms and conditions. Credit in the banking space is the most important asset earning on our balance sheets. If you look at what we had in 2019, by December 2019 of the published accounts, we saw credit taking close to 45% of the total assets of the banking sector. And what we see, credit is the top generating income facility for the banking sector. And last year we had close to 77% of the banking income coming from credit. Along the way, we've seen a lot of evolutions around credit, right from the traditional modes of credit, the ones we saw where we would see shop credit as one of the forms, we would see person-to-person credit, and to the more advanced and contemporary credit along the way. We're going to have a dive into some of those facilities that we see now, but also what we see ahead in the future. But most importantly, we want to zero in down to the terms and conditions. What are the terms and conditions of these credit facilities, both from a retail credit to the consumer credit perspective? But most importantly, we need to focus on the terms and conditions. These were triggered mainly by the introduction of the key fact documents. They brought out the need to focus on the terms and conditions. And we see this has brought in a lot of discussion around that. So to take us through this detailed discussion today, we have a panel of 2 very able presenters, very able panelists that I'm going to introduce to you in a while, that will be leading us through this journey for us to appreciate the credit facilities and what are the terms and conditions today, but also giving an outlook for the future. Ladies and gentlemen, allow me to introduce to you our panelists. And to start with, I'll start with Ms. Sarah Namuyomba Mirembe. Ms. Sarah Namuyomba Mirembe is a seasoned banker with over 10 years working experience in banking and has held several roles as credit manager, as collections and recoveries manager at KCB Bank Uganda. Ms. Mirembe holds a Bachelor of Science degree from Makerere University, a Master of Business Administration from Makerere University, and a number of certifications in the subject matter of credit, including credit analysis, loan pricing, regulations, non-financial credit and asset analysis, risk analysis for specialized loans, and certificate in banking and cashiering from the Institute of Banking and Financial Services. You're welcome, Sarah, and we shall be able to hear from you later on. Ladies and gentlemen, I'd also like to introduce our second panelist of the day, Mr. Paul Nwagaba. Mr. Paul Nwagaba is a seasoned banker as well, a profile that has spanned over 2 decades in the financial services sector. And during his time in the financial services sector, he has worked in a number of financial institutions, a number of commercial banks, at Centenary Bank, Nile Bank, and Stanbic Bank before joining Housing Finance Bank, where he started the banking unit in 2009. Paul has been involved in strategy and business development, credit risk management, portfolio sales and relationship management across both the banking, mainstream commercial banking, and microfinance sectors. He has particular interest in the development of products that allow financial institutions to open to new markets and broaden their outreach. Paul holds an MBA from Edinburgh Business School in Scotland, has a postgraduate diploma in financial management from the Uganda Management Institute, and is a graduate of economics from Makerere University. He's also a certified balanced scorecard practitioner, and as a passionate CEO apprentice, worked with industry colleagues to establish the Changemaker series, a career development initiative for students at tertiary institutions of learning in Uganda. So Paul also brings a mix of this of experience to the panel today, and we are very glad to have the 2 panelists coming to take us through the credit facilities. At this juncture, ladies and gentlemen, we have a simple poll which would request you to partake of, so that we get a little feel. Just before I invite our first presenter, Derek, can you please run the poll so that we can have the members get part in the discussion? On your screen, you'll be able to see a very quick poll. Just kindly give us some feedback so that we can get to dive in a little bit more on your expectations. We'll give it about 2 minutes of this, and then Derek will switch it off, and I'll invite our first panelist. Okay, we have 59 attendees so far, and hopefully you're all able to go through the poll. Kindly give us feedback, and then we shall share the statistics later in the course of the presentation. Great, thank you very much. Derek, I think we can now go to our first presenter. Madam Sarah Namuyomba Mirembe, please, you're welcome to take the floor and take us through the first presentation. Thank you.
Good afternoon, everyone. My name is Sarah Mirembe Namuyomba from KCB Bank. I would like to take this opportunity to greet all our customers out there. We really love you and we appreciate you. So I'm taking you through credit facilities, their terms and conditions. And I've brought a PowerPoint with me to facilitate me going through. So we are going through the credit facilities. We had talked about the overdrafts being short-term in nature, meeting daily cash flows, and interest being utilized on only the amount utilized. So we are back to term loans, and we had dissected them to include short-term loans, medium-term loans, and long-term loans. These ones we had said that they are long-term in nature, but because of the nature of the profit, meaning that the profit of the business is not short-term, that is why a person opts for a long-term loan. And they are basically for increasing stock levels and expanding business. Then also the repayment period is usually fixed or floating. And they give you a schedule that can run from like 1 year to 2 years, and every month you have like a repayment and on a specific date for the repayment. Then also they are very useful in purchasing fixed assets such as the new building, machinery, basically business expansion. So the examples of clients who are suitable for these, there are quite a number, but the ones I could think about are the hardware stores. Those ones, it takes some time for them to generate the profits. However, they need to expand businesses to meet the supply. Then there is the supermarkets. The supermarkets usually can go for the short-term and long-term loans depending on the particular need. Then the manufacturing companies, a manufacturer has to buy raw materials, then processes them, then sells and after getting the finished goods. So therefore he needs a term loan because his profit is not like immediate. Going through to the next, there is also the short-term loan. The short-term loan is among the term loans given, and these ones are for short working capital. They do not exceed like 1 year. Basically, it's below 1 year. Someone can come in and ask for 6 months, 8 months, depending. Also, the repayment is usually a person can say, I want to pay, for example, 500 million in a bullet after the 6, 7, 8 months, or pay monthly interest and principal, or pay quarterly or semi-quarterly, depending on the cash flows of the company. Then examples of these are usually traders. Again, you see supermarkets sometimes go for short-term loans to meet their short-term working capital needs. Then we have the retail shops, boutiques, and also the big corporates also come in for these particular ones. Then the other interesting credit facility is the asset-based financing, also commonly known as ABF. This one is financing basically for movable assets, all those assets which a person can carry from point A to B, a term does movable assets. These ones include the vehicles, the plant and machinery, the earth moving equipment, office equipment, generators. Many schools come for school buses, heavy commercial vehicles, tractors, pickups, name it, just as long as it's a movable asset. These ones, they finance, banks finance depending on the date of manufacture and also depending on the bank's policy. The newer the asset that you're financing, the better the amount of money you're going to get. These particular assets need to be valued to understand what exactly the bank is taking on before it actually takes it on. And these valuations are usually done by independent valuers and surveyors. Then the financing can range from 50 to 100 depending on the year of manufacture. And we have said that if the car or tractor is new, then there it can qualify for 100% financing. Then also because they have a depreciation element in them, and they are prone to things like fire, thefts. We usually do insurance premium financing. This is a tripartite agreement between like a bank and a customer, then an insurance partner who comes in, and the bank releases money to the insurer, and then the person ends up getting a loan which he can pay within like 10 months of equal installments. Also, it's not about like shipping these assets, but we second-hand ABFs, which are already on the road and on the market. So onwards, the other credit facilities that we could talk about in this particular topic are the trade finance facilities. These ones basically meet the needs of financing operations, managing liquidity, and mitigating risks inherent in trade. Usually, like a person who wants to import goods and services doesn't trust the importer out there. Maybe the importer could be in China, Canada, wherever. So what they do, they come to a bank to be able to give these particular guarantees such that a person can be able to ship and also pay the money to the importer or exporter without actually having met them in person. So the bank takes on the risk. So these ones range from guarantees, and the particular guarantees include bid bonds, performance guarantee, advanced guarantees, retention guarantees, supply and payment guarantees. Also under this category, we do the import loans. These are particularly to import goods and raw materials where the customer is willing to import the raw materials, processes them and sell the goods, then be able to pay the installments, or already wants to buy, import ready goods just for sale. Here, the bank handles the entire transaction from sending the money to the importer and then making sure that the right documents are in place for the client to receive their goods and services. Also among this is invoice certificate discounting. Certificate discounting. Here the contractor, upon like supplying goods and services to a contractor, they receive what they call an invoice or a certificate, but they do not want to press the person or the employer for immediate payment of money. At the same time, they want to have money to be able to do what? To do other ongoing activities of their company. So they approach a bank, and then we look at the invoices, we discount them. In KCB, we usually do like 70% discount factor. And then we can lend against that. The only condition here is that the employer or the person they have supplied to has to give bank guarantee that they will channel the funds to the respective bank when they actually pay that particular customer. Then also we have contract financing. Contract financing, we can finance up to like 100% of the contracts, depending on whether the person who has gotten this contract is willing to like channel the funds through a bank or KCB. Then also we have letter of credit. Letter of credit, the customer like approaches a bank and tells the bank is interested in shipping some goods from maybe from a diaspora supplier. There the bank takes on all the risk and gives this LC letter such that the supplier can be able to supply the customer A in Uganda, and then the bank will be able to remit the funds upon receipt of the goods that were supplied. Then the other important credit facility, which we usually do as banks, is the agriculture loans. And agriculture loans are usually done in partnership with the Bank of Uganda and Ministry of Finance, in partnership with the Uganda Bankers Institution, where we made an MOU to be able to give these agriculture loans to outside customers. So some of the terms embedded in agriculture loans include like the installments being, we put the consideration of the installment to consider like the seasonality of the crop. Let's say the person we are financing is a farmer for coffee. There we try to streamline the repayment to be probably once in a year, because the coffee is usually harvested once in a year. Then maize farmers, we do not do like the full termly loan. We usually do like twice a year. And poultry farmers, depending on how we expect the cash flows or the money to come in. Also, we do insurance for this particular loan, because it is prone to the various pesticide to the various pests. Like agriculture, it's prone to so much. It relies mostly on the climatic condition of the environment. So that is why we usually caution the farmers by taking out an insurance policy against all those various risks that we can identify. So how does the bank do it in partnership with Bank of Uganda? We usually get appraisals. After appraising and seeing that everything is in order, you forward this particular facility to Bank of Uganda for further scrutiny. If they give a go ahead that everything is okay, the business plans are in order, we go ahead and disburse the funds to the particular client or farmer, of which we get reimbursed for like a portion of the money you have disbursed to the farmer. Then also when the installment comes in, we usually share between the participatory financial institutions and Bank of Uganda. And this facility is usually priced low, very low, with interest rate as low as 15%. Then last but not least, I would like to talk about that all these credit facilities do not work alone. At times the bank stimulates and give like a cocktail of products to a customer. Like imagine a client who is involved in agriculture, wants an agriculture loan, but this agriculture loan is meant to maybe finance an asset, to import an asset. Basically, this is like a cocktail of like three, four loans. It's the farmer is involved maybe in commercial maize planting. So of course that is already agricultural loan. Then it's an import loan. And at the same time, they want maybe a tractor. So we usually get all these terms together and try to combine and give out a better product to the customer. So on the screen, I have displayed some of the requirements that the banks look out for. And the requirements are basically the loan application form. This one requires you to get a passport photograph, or if there are many directors, all of them should present their passport photographs. Then audited books of accounts for at least 3 years. 3 years with the most current years going downwards. Then also we usually request for bank statements for at least 12 months. Then financial card if it's a person, then we usually only ask for that individual financial card or the CRB report. But if there are many, like it's a company, we again ask for those particular financial cards. This is meant to give us the credit history of the particular client. Also, we require that the person has an account with a bank, then trade documents like receipts, invoices to see exactly if the person is using that particular business which he has portrayed to deal in, trading license, tax compliance to make sure that they are tax compliant, they pay the taxes in the land. Then we ask for some company documents like the certificate, the certified memorandum and articles of association, certificate of incorporation, valuation reports, then identification documents. These are IDs which should correspond to the names also on the other documents that we get. Then on some instances, we ask for business plans, projected feasible reports. Then we ask for a copy of duplicated title deed or logbook in case the loan you're going for is secured. Also a resolution to borrow, like for companies, companies is not a one-man show. Usually various directors have to give a go-ahead for the company to borrow. Then insurance policy where necessary, and also spousal consent if the person is married. So last but not least, I've highlighted a few challenges that affect these credit processing on your screen. One of the biggest challenges is poor loan structuring. Oftentimes customers who are given poor loans, not structured well to fit into what they need and what they do, they always get challenges. Also, most clients do not have good bookkeeping habits. The bank keeps asking for documents and the business is not able to present them, like keeping the invoices, keeping records of sales and stock levels. Most of our businesses do not have them. So if I'm talking to any business owner out there, they should be in position to keep records very well and maintain them, not probably for borrowing per se, but for the future of their business. Also, the credit history, some clients really want the facilities, but their CRBs are really not so good, with many days in default. So it's quite challenging. Then the other challenge we usually face is lack of homogeneity in documents presented. A customer presents maybe the task, the CRB has another name, the ID has another name, then the other documents also do not speak to that particular person who is in front of the relationship manager. Also, the other challenge, and mostly, is poor banking habits. Basically, some clients prefer to keep their money with themselves and do not want to put it in banks. And yet banks usually ask for these bankings to evaluate the business. The other one is diversion of funds. Oftentimes when clients bring these nice proposals and then you give them money, they think of all the other ideas of what they wanted to do with the money and forget about the business. So the business is left suffocated. Then also, there are some clients who are into borrowing a lot. You look at their financial card and within a space of 6 months, the person has moved from like 6 banks and they're giving him facilities and the business is very slim, which he cannot handle without breaking the business. Then the other one is poor business succession plans. Usually our businesses in Uganda, they are run by one person, and yet the facilities they want are long term. So you're imagining that if this person now is away from the business, what will the business look like? Will he be able to pay the bank money, or will the business be able to move on to the next generation? Then last but not least are unclear customer needs. A client comes into a bank and he just wants money, is not sure the money is used for what. He has so many things where he can channel the money, but the source of income is probably one. So I would like to thank you very much. That is the end of my presentation.
Wow, wow, wow. Thank you so much, Sarah. Thank you so much for breaking it up and sharing that practical touch of the discussion. Looking at the charts, I see a lot of comments. People actually thanking you for the presentation as number one. The number of questions that are coming in terms of sharing the presentation. What I can assure you of is the Institute, the Uganda Institute of Banking and Financial Services, we have arranged the presentation, and they will be sharing to all the registered member participants, but also on the website, www.yourmoneycan.or.ug, we shall have the presentation there, the whole recording of the replay, and what has been presented by Sarah and the next panelist. Just to assure you, the members, the audience today, we thank you so much for attending. We're enjoying the discussion so far. And we have a Q&A. If you look at your icons, you will see the Q&A. Please let your questions come through. And let's keep engaged to the chats, the feedback, and we shall be able to address as we come forward to the next sessions. At this point, ladies and gentlemen, allow me invite our second panelist of the day, Mr. Paul Nwagaba, who is Head of Credit at Housing Finance Bank. Mr. Paul Nwagaba, over to you, sir.
Thank you, Silva. I think I'll be helped by Benedict to just put up my presentation. Maybe as he puts it up, I'd like to just thank the Uganda Institute of Bankers and Banking and Financial Services for putting together this series, and all the institutions that have supported this initiative. It is useful, and I'm sure those who are attending will agree with me that many times the inability to access financial services is not because people don't have ability, but they don't have enough information. So this is a very good initiative on the part of the financial institutions, and also to welcome all our attendees today. My presentation is going to be specific on consumer credit facilities. You'll notice that that my colleague Sarah concentrated especially on the enterprise side. So I will focus my own presentation on consumer credit and talk through the terms. I have about 9 slides, and I hope that those who are attending will find it useful. So Benedict, if you can move to the first slide. Moving to the slideshow, Benedict. Maybe let me start as you put up the slideshow. I believe those who are attending, we can see it, but maybe it would be useful if you could just click the slideshow so that the slide is actually displayed in full.
Okay.
Please go back. From time to time, we receive feedback that the jargon that we use sometimes can be confusing to those who use financial services. So I just wanted to define consumer lending. In our case, Consumer lending is that which is centered on individuals and household consumers. So it's really that financing or that lending that we provide to individuals. And what does it service? It essentially services requirements such as homes, those who are looking to purchase homes, those who are looking to construct homes, for that individual need of getting a home. There are personal needs where sometimes you need money for personal use. It could just be consumption. And for that reason, you access a loan from a financial institution or a kind of financing that is personal in nature. There are also loans that we take for purposes of purchasing vehicles. And those essentially fit in household needs, as you see. So broadly, consumer lending, wherever you find consumer lending in the market, typically focuses on individual or family purposes. Next slide. This slide describes part of what I've just talked about. I know we hear a lot of the word mortgages, but mortgages is really about purchase or construction of a residential or commercial property. That's really the definition of mortgages as you see it in any display or adverts that you see from financial institutions. So if you wanted to buy a residential house in Chira, or if you wanted to construct a foundation for on a vacant plot that you have, and you needed a financial institution to help you, it would be a mortgage that would be the type of loan that you access, and that would also be a consumer loan. There is something that is provided by way of card, or financing that is provided by way of card. You go to a financial institution. I know that not all financial institutions in Uganda provide that, but some do, where you, based on your earnings or your account conduct, you are given access to a card that has a limit on it, which allows you to be able to use that card at points of sale with a merchant, physical merchant, that could be a supermarket, where you can go online, put in these card details, and be able to purchase something off an online store. Usually, those are credit cards. And a credit card works in almost the same way as the overdrafts that Sarah described, based on your account conduct or the arrangements that you have with a financial institution. The bank gives you a limit. It could be 1 million shillings, it could be $10,000, which is money that you may not actually have in your account at the time, but it's a limit that has been given to you, an arrangement that has been provided to you for you to draw upon so that you can make the purchases that you require on a day-to-day basis. I've talked already about auto loans. Those are described differently by different institutions. Some people call them auto loans. Other people are very direct and say they are motor vehicle loans. Essentially, it is financing for the purchase of a motor vehicle. This is distinct from the leasing that Sarah described. Leasing is usually, especially in our market, it is usually used for commercial assets. So you're buying commercial vehicles, or you're purchasing commercial vehicles, but you buy them in a manner that you don't pay for them up front, but you pay a lease rental over time until after a period, maybe 5 years, maybe 3 years, you own the asset. The auto loans are different in that you take out a loan, you pay the person who is selling the car to you, and then you will pay the financial institution by way of installments that you will agree on frequency. In our market, we also, there's something, one of the consumer loans that could also be out there is student loans, usually for financing education. That's not a product that is very common in this market, but I believe that as we diversify our products, it's also something that would be available to us. But in many other markets, it is used to provide financing for education. So you're sending a child into a university somewhere in the United Kingdom or to the US, or even within this country, assuming you had access to the loan, and you don't have all the money up front, but you have the capacity to be able to pay within a certain frequency, you access a loan. Or if it's the student sometimes could access these loans and pay based on what work they may have, or if they have access to a benefactor who can support that education. I talked about personal loans already. Those are used by customers for all kinds of personal purposes. It could just be for consumption purposes, and you access a personal loan from a financial institution. Next slide, please. So how do we become eligible for these loans? There are two main aspects that determine the eligibility of a customer to access this loan. One of them is that you have income from gainful employment. So you are employed somewhere, and it can be verified that you're employed in that enterprise or that company or that institution. If you can provide that proof either from your HR, then you should be able to access a loan, a consumer loan from a financial institution. We also know that there are also people who have businesses where they've kept records well, and they can actually prove, as Sarah was saying, that they have these records, they have a certain account conduct through accounts that they already have, and they would like to access some of those loans that I have mentioned. Again, if they're able to provide this information, they would be eligible for these consumer loans. I think what we know in this market that is more common, of course, is the one that is gainful employment. But if you're talking about cards, if you're talking about even some of the other consumer loans that I mentioned, like mortgages, when you have your own enterprise and you can show the income that you make out of it, you would have access to those consumer loans. The other issue that would be core for people who want to access consumer loans is affordability. So it's one thing to want the loan. The other thing has to be based on the income that I have, how much can I actually afford to take as a loan, or whether I can actually qualify based on the income that is available for me to spend in repaying the loan. Now that one will vary across different financial institutions. Some will tell you if you have income of 1 million, we are only willing to consider 35% of that as income that you can commit towards repayment. The idea around affordability is also to allow the borrower an opportunity to have money other than that which they are paying to the financial institution to continue to survive or to continue to meet their everyday needs. It's a question that financial institutions always have, because borrowers come and say they want to take out as much as the salary that they receive on their account, and they are always contesting or having a discussion with the financial institution around the affordability. But there is also the responsibility to inform the borrowers that you have to be able to limit how much of the amount of money that you receive monthly, even from your business, that you can commit towards repayment of consumer loans. So that's usually a percentage which varies from institution to institution, but it is what defines the affordability, and it's what then guides the financial institution on making a decision to give you a consumer loan. Next slide. So specifically for mortgages, I just wanted to touch on that a bit, because in terms of eligibility, there are some things that you will be required to provide, that you would need to have to be able to qualify for a mortgage, for example. So one of them is, especially in our market, that you would have a valid title. The issue of having valid title is to be able to provide an opportunity for transfer, assuming you are buying the property, but also for contestation in the event that you had a problem. You can imagine if you bought land from somebody and you have no way of enforcing their ability either to transfer it to you, if they've taken your money and you are not able to prove that you actually bought the property in a legal manner, or that you can have that property transferred to you in case someone else wanted to contest it. So you will find that usually from a consumer loan perspective, when you are buying property or buying land specifically, or constructed property, you'll be required to provide valid land titles. The other thing is we obviously exist in a legal environment. Your house will not exist on its own. It usually exists in a location. If it's in Kampala, if it's in Mbara, if it's in Arua, usually there's a local authority around there that has ordinances that they would expect a house owner or a home owner to be able to meet. One of the common ones is that if you're going to build a property, or if you're going to own a property somewhere, that it has, I see the presentation has gone off, that property actually has the right plans approved by the local authority. They may not just be plans, they could be other things like ground rent, which you would like to have so that you are able to convince the financier that you are in the right legal environment before you are financed for anything like that. That is also a requirement of the people who sell to you these properties. Benedict, I noticed that the slides keep shifting. But if I can go on, as we sort out the slides, I was saying that for mortgageable property, you will need to have any authorizations that the local authority must give you must be in place. That allows you, again, to limit contestation, but it also protects your property. Remember that in an environment where you may be constructing, for example, if you constructed in a road reserve and the city council or the municipality was developing a road, wanted to expand the road and came and knocked down that property, if they have not given you approval to build because you have gone out of the scope of where you're supposed to build, you will actually lose money. So you'll find that financial institutions will insist that even when you have a permanent structure or you are going to build one, that you have the right kind of approvals. The preference also for mortgageable property is that you're going to construct using permanent materials so that indeed there is value retained in the property and that it's something where changes can't be made easily, but also that in terms of disposal, if you wanted to dispose it, you have good value that you can dispose. Also, the property should be serviced with the typical services, which is water and electricity. Again, those help not just you, the client, because of usability, but they're also useful for the financial institution in retaining the value that has been provided to you through the loan. You will find that there are unique variations that institutions will make. Some institutions may actually be willing to give you financing for mortgageable property, even where titles may not be there. They may give you financing against a lease offer. In some cases, they may actually lend you against customary land, for example, where the local authorities have written out a kind of document saying that they know who the owner is. Sometimes if you exist, if the property that you are buying is in land that is customarily held, you may even just have a simple sales agreement, which the financial institution can also accept and lend you against that. But like I said, that varies from institution to institution. It's a conversation that you would need to have with your bank or your microfinance or any other lending agency, which will then make the loan to you based on what they consider to be an acceptable risk profile. But some of those unique variations also come from who is the profile of the borrower, what are the kind of loans that we give, do we have specialist products? You find that banks sometimes have arrangements with institutions outside the banking industry to provide certain specialist products, and sometimes our borrowers can benefit from those partnerships in terms of those products and some of the unique structures that they provide. So those are also unique to different institutions. If we could go to the next slide, Benedict. The next slide is on consumer loan sizes. Now these ones vary again between institutions. Some institutions would give you as low for consumer loans as low as 100,000 shillings, or even less, depending on how far down you go within the financial sector. But also the size upwards will then vary according to a few other metrics, which I'm going to talk about. So for mortgages, for consumer loans, sometimes you'll get 100% of what you require. But one of the things that is unique about mortgages is that usually you will be required to provide as a borrower, you'll be required to provide a contribution. And that one again will be determined by the financial institution. They will set specific conditions for you to either bring 10% or 30%, or in some instances, they may say you don't have to make a contribution, but you will need to provide a specific insurance, for example, for the contribution that you would otherwise have provided. That one is usually to make sure that the borrower has an attachment to the property that they are buying. And to that extent, they will also want that you make a contribution towards that. In terms of facility type, we talked about the 4 or 5 categories of facilities that you would access as consumer loans. Those ones vary based on the lender. Okay, so if it's credit cards, like I told you, some financial institutions will give you credit cards, others may not. So that one will vary between lenders. Sometimes the location of property, for example, will determine whether one financial institution will give you a mortgage there or not. I have also told you that where you are dealing sometimes with an institution that is willing to look at other forms of land ownership, for example, you will also have you'll have those institutions also talking to you specifically about the location of those properties and the documentation of those properties, but also the size of funding that they would be able to give you. The amounts are largely defined also by your capacity to pay. So if you're earning $1 million shillings and you wanted to take a mortgage of 300 or 400 million, clearly you may be out of the scope. Remember that I also said the lender will define how much they believe is acceptable as a percentage of your income that you should commit towards repayment. So your capacity to pay will also define the size of loan that you can access. And you need to be able to have that conversation with your financier and say, I earn $1 million shillings. How much are you willing to receive as my repayment? And therefore, what does it mean for me in terms of how much I can pay, but also how much I can access? These conversations are important for you because sometimes when you're also making a commitment to buy a property, to buy a car, you need to be aware, how much can I actually access based on the income that is available to me? The other very important thing that determines consumer loan sizes, because you all have the other issues around the capacity, about the location of properties, sometimes the value of the vehicle that you're buying. One other thing that financial institutions will look at very closely is your credit repayment record. When you pay well, typically a lender will be willing to take a little more risk with you because they believe that you have earned the right for them to take that risk. Remember that financial institutions generally lend money that they have taken from the public. And because of that, they are keen to make sure that that money is actually repaid. I know there's a false impression many times that is in the market that financial institutions are interested because you have security on selling the security that you will provide. The security is only taken as a last resort. And there has to be every effort is taken by the financial institution to make sure that you do not actually get to the point where you have to sell a customer's security or collateral. And to that extent, these aspects that I have described around how much you earn or how much you are generating from your business, the kind of contribution that you've made towards the loan, where the property is located, what type of facility you will take, how much money will actually be given to you, and your credit repayment record are very, very important in determining the kind of money that you will access. But I wanted to just emphasize a bit about the credit repayment record because for many customers, that is something that they really get when they want to have conversations with financial institutions, but it's a very, very important parameter that has to be considered. If we could move on. I wanted to talk about the general conditions before I dip into those that are specific to other to how you split the consumer credit. Generally, terms and conditions will vary based on institution and based on borrower profile. What do I mean by borrower profile? A borrower can be profiled by how much, what their income is, what their credit record is, which sector of the economy they are in, where they are located, what kind of business they are doing, which kind of institution they're employed in. All those feed into what someone would call a borrower profile. And different financial institutions then assign a level of risk to each of these profiles. And when they assign that risk, they then decide what kind of facilities they want to give to the borrower, but also how much, what length of period, and so on and so forth. Basically, it defines the terms that they would then give the borrowers. There are two things that you'll also see a lot in consumer credit in terms of terms and conditions. They will be split between those that are secured. Secured is where you are going to provide security. And then unsecured is where you will just make a commitment either from your employer or an arrangement with the financial institution or bank, where based on an arrangement of trust, they are willing to advance you money without necessarily taking a physical form of security. And then the other term that you have to look at is what is the length of the loan, or how long is it available to me? That can stretch anywhere from 1 month to 6 years. It could even be longer. If you're looking at mortgages, they would go as long as 20 years, and in some cases 25 years. But in this market, the more common is that you'll see mortgages of 20 years. But you have short-term consumer loans, which can even be taken for 1 month. And sometimes when you go to the microfinance industry, you could even take facilities for even a week. So that length, again, depends on what are you doing and how have you been profiled by the financial institution. The frequency, it can be monthly, it can be weekly. The frequency of repayment, that is, it also is very dependent on how you generate the money that you are using to repay. So if I'm somebody who works in a market and I sell goods daily, I might actually want to pay my money every week. And I must inform the financial institution that that's how I generate my money and that's how I will repay. If I am someone who is earning a salary, a monthly repayment may be appropriate. Again, it comes from the conversation that you have with the financial institution. If it's quarterly, you'll find that there are people who, for example, are property owners and their tenants only pay them quarterly or they pay them every 6 months. That conversation must happen with your financial institution, and then the repayment frequency is structured in the transaction that you'll have taken. So if I've taken a commercial mortgage, I'm building 12 apartments in Chira, and my tenants, the arrangement I have with them is that they'll pay me quarterly. There is no reason whatsoever why I should go to a bank and be asking for a monthly installment. You'll be putting yourself at risk of default, and it will affect your credit record, which is unnecessary, yet you might actually be generating the money, and you only need to be able to inform them about how you generate your money. There is always, of course, the conversation about interest rate. Again, this one varies by institution. What happens with institutions is we all source our money differently. We either borrow from the public, we borrow it from institutions, we pay interest to some of our depositors, and that feeds into the pricing or the eventual interest that the customer finds on their loan. But that is not the only determinant. There are things like the conduct of the customer. If you have been paying poorly before, it is assumed that the potential for risk from you is high, and you will find that your institution usually increases your interest rate because of the risk that is associated with you. So that's why I mentioned earlier that the issue of credit repayment is very important, because for someone who is borrowing, it eventually impacts you in terms of how you will be priced by the institution that will be lending to you. Of course, we cannot forget that the economic environment around us changes. This money is taken from the public. Customers who deposit money in financial institution also have alternatives with which they can apply to where they can apply this money. So it comes at a cost. So when that environment changes, it also means that invariably interest rates change. So you need to look closely at your agreement when you have a conversation with the financial institution. Institutions vary their interest rates because of how the economic environment also changes. So you'll be advised about a prime rate, which can change whenever you see an announcement in the media about a prime rate change. And that usually also affects the size of your installment. And it's something that you need to be able to be aware of, but also to have a conversation with whenever you are engaging with your institution about a personal borrowing. I needed to talk about something around penalties. Many customers who default sometimes are unaware that penalties are applied because you have agreed there's something in your agreement that requires you to pay on time. The institution will also penalize you when you don't pay on time. So they will increase either your interest rate or attach a specific fee for a period when you are delaying to pay. So you need to be very keen on those penalties and make sure that you actually pay on time, but also that you are aware that those penalties exist and that you provide for them where you are unable to make the payments on time. The fees generally will be contained in documents that you sign, in the agreement that you sign, in something called a key facts document that you also must sign. In there, you'll find what your financial institution has provided for as fees for your application, for arranging the facility for you. There are also fees that are paid to the government. For example, when you take out a loan, it's usually registered. So some stamp duties are paid to the government. If you have a mortgage, that mortgage must be placed with the lands registry, and therefore some fees must be paid. So you have to look out for these fees. Financial institutions also, by their very nature, are engaged in monitoring borrowers from time to time. They have to visit your property. They have to check on how borrowers are performing at their businesses. And to that extent, in many instances, they also charge monitoring fees. So you need to look out for those as well in the terms and conditions that are in your agreement. If I go to the very specific to the unsecured, three things that I just wanted to focus on there. One of the main requirements of unsecured loans is we will require some kind of undertaking as financial institutions from an employer, especially when you're in gainful employment. You'll be required to provide an undertaking from your employer about how your salary will be paid, how much you earn, and then you'll obviously be required to provide documentary proof, salary slips. But if you are self-employed, more often than not, you'll be asked to provide proof of money that is going through your account. Those are the account statements that you're requested for, and also audited statements. The audited accounts really are just to say, let's have an independent person who actually verifies the financial information that you have provided. It's not about financial institutions being difficult, but it's just to be able to avoid the possibility that information or misrepresentation can be provided. And then, of course, you'll have an application which you fill out, usually a form, and then you have a borrowing agreement. Those are the common ones that you see around the conditions that we set for you. If we go to the secured facilities, which is my last slide, I think I've been, I hope I'm still within my time. I talked about some of these already, but those will be added to the general requirements that you will have. That is the preference for valid title in one way or another. Even if it's customary, there will have to be a way in which that is documented. The approvals that I mentioned to you, where you are dealing with a local authority of any kind, they will require that you also meet the terms of their ordinances in that location. When you are buying a property, you need to have sales agreements. There has to be proof that indeed you have engaged with somebody who is willing to sell to you a property, and that there's a price to it, which is consistent with some of the money that you will be requiring from the financial institution. I already talked about the local authorities, and then again, you'll have an application and a borrowing agreement. I believe that's my last slide. And back to you, Silva. Welcome some questions.
Yes, thank you very much, Paul. That was wonderful. That was fantastic. We had a great detail of the discussions, and from the consumer perspective, while Sarah took us detailed on the corporate lending. Before we open up to the public, to the audience out there, we had a poll at the start. Let's see what the poll is saying. Over to Benedict. In terms of our age, 47% are between 26 and 35, 35 between 35 and 45, and 16 about 46 and above. Wow, pretty much we are in that productive, the audience is still productive and active in credit. That's what we want to see. And 79% of us have access to credit, meaning the discussion is very pertinent and it actually talks to each and every one of us. Do you normally read the loan and terms of conditions? Sometimes, 51%. The audience is telling us we don't give much attention to the terms and conditions. And probably as we see the aftermath of the learning process, what would happen if we didn't know the terms right from the onset? Good enough, the panelists have given us some good insights about the terms and conditions, so we can ably start picking it from here. And as we are getting our next loans, we just go and start checking on whether all the terms are covered there. Do you seek to understand the loan credit terms and conditions? Yes, 70%. Wonderful. So this gives us a good indication of the topic of study today and what the audience is perceiving the terms and conditions. And this is a very good representation of the topic. And we thank you, the Institute, for selecting such a wonderful topic. Going to the panelists, we have a number of questions coming through our Q&A, and we have some that are coming through the chat. I would encourage you to look down in the Q&A. If you could find some you can address right on the screen, or we shall have to discuss a number of them depending on the time we have. But just going to poll, I want to look at from a consumer perspective of credit. What are those conditions? What factors would you advise me to consider when I'm selecting a type of credit facility? You know, you have many of these consumer facilities we've taken us through. Sarah has shown us a number from the corporate side. Now, from the consumer perspective, what factors would you advise the consumer to consider before choosing a facility?
Okay. Thank you, Silva. What I would recommend from a consumer perspective is, especially in choosing the type of credit facilities, the most important thing is to establish what it is that you are going to do with the money. What's the purpose of the loan? So if I'm going to buy a house, that's a long-term commitment. So is there a long-term product in the market? If I'm going to buy an asset, a leasing asset, if I'm buying a truck that generates a certain amount of money per month, but still would be depreciated over 5 years, what kind of facility do I want to access? So it's the purpose for me is paramount. You need to be able to know what it is that you're going to apply the funds to. The other one is the complexity of the different facilities that if you've determined the purpose and you say, okay, I want to pay, say for school fees, the next question has to be, how long will it take me? What is the complexity of the transaction that I would need to be involved in? If there is an option to access a salary loan, should I then go for, maybe a personal secured loan or something like that? So it also goes to the complexity. Should I take out a loan where they're going to ask me for security? Maybe not. Can my employer just guarantee that they'll pay my salary into the institution? And if I pay my fees over 3 or 4 months, that's okay for me. So the level of complexity would then come into the equation. The other thing I think that is also critical is the pricing and any related issues around it. When I talk of pricing, I mean your interest rate, your penalties, your fees. Those would also be very important for you in then determining what's the type of credit facility. Remember also that pricing is not just the rate that you have been given, it's also how long you're going to hold that facility for. If I hold a loan for 1 month and it's at 26% per year, and I actually hold it for one month, the prorated, I may actually pay out less money than if I took the loan for a year, and it's at 18%. So the question has to be, how does the pricing relate to how long I actually need the money for? And then you make the decision. Those would be the three broad areas where I would focus. What's your purpose? How does it fit within the financing that you require? What's the complexity based on the purpose that you have determined? And then how is it priced? Is it cheap enough for me to access? But also, even if it may not be cheap, since depending on how long I'm going to have the money for, can I viably take the loan and service it and complete it? Those would be key for me.
Okay, thank you, Paul. Thank you very much for highlighting on that. Just before Sarah, I have one more for you, Paul. You see, in the mortgage customers, what approach would you recommend for customers to take in case of disagreement with their lenders?
Okay, of course, disagreements vary. It could be, I think the main one is this, which we always tell our customers. And I would encourage anybody who is listening in to keep that at the back of their mind whenever they're taking a loan. You must remember two things. One is the funding that is availed to you is not money that is owned by the financial institution. The financial institution, for the most part, especially those in the institutions that take deposits, they go to the public, they receive deposits and commit those deposits by way of a loan to whoever the borrower is. So that needs to be at the back of our minds whenever we are going to get into a disagreement. But that is that's really just us being pragmatic. But what I would say as a very important thing to do when you have disagreements is maintain the lines of communication. I think where we usually have a problem is that when you have a disagreement with the institution, the first thing that you do is either you cut the lines of communication, you take your phone off, you leave the place where your known place of abode or wherever you are working or wherever you're doing your business. Sometimes you then choose to go, for argument's sake, the legal route quickly before you've had an opportunity to, as much as possible, engage with the financial institution to try and arrive at, to meet each other halfway, so to speak. So you have a problem with your repayment, you are not able to make the repayment. The first thing that you should do is go to the bank and say, for one reason or another, I'm not able to pay. Or I disagree here, the interest that I was charged was wrong. Give the institution an opportunity to engage with you to be able to resolve the issue. When we cut the lines of communication, we then have difficulty because it means that you all have to look for other forms of recourse, which many times are unhelpful, either to the borrower or the financial institution. So the lines of communication are very key.
Oh, thank you very much, Paul. Thank you. And now to our second panelist, Sarah. On 1st of April 2015, Bank of Uganda introduced the key fact documents, pretty much to throw the terms and conditions into the faces of the customers. What impact have these key fact documents created as regards to terms and conditions of credit?
When the Bank of Uganda introduced the key fact documents, basically it was asked to the financial institutions that we have to put all our terms and conditions onto the paper and be known to the customer before actually they are able to take the facility. So one of the impacts was that the customer got to know that actually there are these terms which I'm supposed to look at and address before I accept the agreement of taking the loan. One of the highlighted terms are the period or the tenure of the loan, which is usually highlighted in that document, the key fact document. So the customer gets to know that I'm going to pay the loan from date A, maybe 1st January, and then it will stretch up to 2-3 years, and know the date on which she's supposed to do what, to pay that particular installment. Mm-hmm. Also the interest rate, it highlights properly a gap of how much you're going to charge the customer. and it gives room for the customer to see if that rate you've set out is high for them, or it's high and they can be able to negotiate it further lower. Because usually Bank of Uganda gives the best rate, as in the rate below which you cannot go. But then the room for negotiation between the client and the financial institution is left to the talks that Paul was talking about. Also, it clearly analyzes who has taken through the customer on all the terms and conditions, because it has a loans officer who particularly has to sign that have set the customer down, and we have gone through all the terms and conditions. So by the time the customer accepts and signs and indicates the date, it means that pretty much they are in agreement with a particular facility that they are taking, and they'll be able to service it. So it's like a binding particular agreement. The other one is like, now we do not have a lot of disputes, because you, on top of the agreement that you have with the bank, is that kickback document. So when the customer comes up and says, I did not understand the interest at which I was given this loan to, those many complaints are no longer coming up. So those are the many impacts that we have gotten so far. Thank you.
Thank you very much. Thank you very much, Sarah. And we have a series of questions from our audience, our very wonderful audience. And shortly we'll be going through them, but I have one more for you, Sarah. In terms of financial institution, how do you balance the right to customer confidentiality and execution of your duties when it comes to the unwanted situation of bad debt recovery? How do you balance customer confidentiality and you doing your mandate of bad debt recovery?
Okay. You know, there are customer protection guidelines in place, of which financial institutions should never breach them. And one of them is the right to confidentiality given to everyone, the good customers and the ones who have gone to default. And going into default does not necessarily mean that the customer is actually bad. It could be many situations surrounding the customer, why they have really gone into default. So in order to maintain the confidentiality, we usually write documents to the customer to a specific address, because when the customer is onboarded, they usually give us the address of which you're supposed to address the customer or deliver the document in person, not to a third party or any other person. Then the other one is that before you like outsource a facility which has been bad, because banks usually give out these facilities to external agents to collect them, there should be talks between the customer to clearly state that, you know, where we are going, this is what can we do before we go to the actual process of recovery. And amidst those solutions, a customer can choose to maybe say, this is what I can afford at the moment. Please maintain my loan at this installment. That one is too high for me. So there are those negotiations between the bank and the customer to know how you can restructure the loan such that it can fit into his current situation. Sometimes the installment is deferred, like if the customer is not able to pay immediately, you can hold and give him a grace period or a grace period until they come up and say, now I'm okay, I can be able to service the loan. So all those interventions are put up to make sure that the situation is resolved confidentially between the bank and the customer. Thank you.
Thank you very much, Sarah. Let's go to the audience. In the chat room, we have a number of questions and we have others from the Q&A. I'll start with Paul, specific to you from Mr. Philip Besimide. Can non-residents and foreign nationals who want to purchase residential property in Uganda, or for Ugandans who are working and living abroad but would like to buy property in Uganda, get a property loan from Housing Finance Bank? Paul, you have a potential customer already, eh?
Yes, I do. Well, welcome to this forum, Philip. Yes, we do. We actually have a lot of diaspora clients ourselves. And it's something that we provide as long as you have a local resource that can identify the property for you, as long as you are even able to appoint an attorney on this side. If you can't come, we can support you to have this facility provided by ourselves to finance, but we can also connect you to potential developers here who would be able to provide you with options of property that you'd like to purchase. What our involvement also gives you is the sort of the assurance about, one, that the property exists, and secondly, that it is of the quality that you would expect based on what your needs are. But about the financing, that financing we can provide. We do provide it already. We have quite a number of diaspora clients who work way out of Uganda and who are accessing facilities here. So we'd be happy to provide that support to Philip and many others.
Oh yeah, Philip, there you are. Then Paul, you have one more from the Q&A from Mr. Robson Tokahikire. In your explanation for a personal loan, does it mean I can obtain a personal loan using a verifiable income from my business? If yes, under what circumstances? Does it mean it has to be an SMC or any type of business can still gain from a personal loan arrangement? That is from Robson to you, Paul.
Okay, maybe what I needed to clarify is they are consumer loans or consumer credit facilities that you'd be able to access against income that you generate from a business. But typically, depending on what it is that you want to do, we would obviously assess the business for how much income it avails to you, and then give you those. So whether you want whether it's a personal overdraft, whether it's a personal loan, whether it's a card product, as long as we can verify your income, we'll be able to give you those. I said very clearly that from institution to institution, some institutions will actually not make personal loans to business people. They will do a typical business facility, but others will do. So it's really just down to the level of risk and how they can verify your income. But at Housing Finance, we can make those loans to you.
And finally, for now, to Paul, and what is your comment on the maximum amount of penalty an institution can charge? That is from Alex.
Okay, what I know is that it hovers around the 3 to 5% mark. And that 5% is on the amount that is in arrears. So let me just give you an example. If I had to pay an installment of 1 million shillings per month, or for argument's sake, and I was supposed to pay it on the 30th of October, and I didn't pay it, and my agreement, or my loan agreement has a provision that I will pay 3% per annum. By the way, it's per annum. It's not also meant, at least from institution to institution, it may vary, but I know that while it's meant to be punitive, it's also not meant to be unrealistic. It's an additional 3% per annum on the value that is in arrears. So that will mean that they'll prorate the 1 million for whatever period it is that it is in arrears. If it's in arrears for 1 month, then they will prorate it at an annual, at that additional annual rate, and put maybe an extra 30 or so thousand shillings on my installment when I eventually make that payment. So the highest I have seen in the market is about 5%, but it's a per annum rate. That's what I also know. But it's usually between 3 and 5%, depending on the institution.
Okay, thank you very much, Paul, and thanks for that. Now to Sarah. Please help us on two questions. Number one, from Jennifer Baluka, Miss Jennifer Baluka. There is so much pressure from bank staff to salary the workers to take loans. Is there so much pressure from bank staff who are salaried workers to take loans? Sarah, you could help us on that.
In my response, I don't think there is too much pressure from bank staff to take salaried loans. They usually take salaried loans because they are affordable. Bank staff usually take the salaried loans because they are a little bit affordable as compared to the market. Because like the market rate, a loan can go to up to maybe an interest of 20%. But when you are an internal staff, the rate can be as low as 11%. So it's not really too much pressure, but they realize the benefit which they can achieve by taking those salaried loans. Yeah,
Okay.
thank you.
Thank you, Sarah. The other one, before you go, is what is the best timing of taking a credit facility or loan? That is from Mr. Chumuro.
I wouldn't say there is a best timing. It all goes down to what the person really needs at that time. If the person like already has enough income with them and they can go by without any need, then there's no pressure to take the facility. But if the person really sees that there is a need they want to address, any time can be a best time depending on what they want to do and how they are going to pay, going back to their affordability and income. So I think it's purely on a personal basis and knowing exactly what you're going to do with the money and how you're going to pay it. Thank you.
Thank you very much, Sarah. We have one, it's more experience sharing and probably a query. And I think, Paul, you can come in to help on this, if you alluded to this. Mr. Mugari Godwin is saying a letter of undertaking is one of the requirements of an unsecured loan. But on several occasions, lenders struggle with non-performing loans when these employees got loans, change workplaces, or switch to self-employment. Can this undertaking include a clause that guarantees disclosure of information regarding the employee's termination or resignation by the employer, such that the employer is tasked to go back to the lender and renegotiate? That is from Mr. Mugari Godwin. Paul, please help out.
Okay, thank you, Godwin. What I know about letters of undertaking, the structure of the letter of undertaking is down to the relationship that the financial institution has with the employer of the person who is taking the loan. Some institutions even don't want to issue letters of undertaking. Others will tell you very clearly in their notification or in their undertaking that this is not a guarantee. Others may actually even indicate that they would be willing to provide information to support your ability to trace the person who has left the organization after they've left. You have to consider also that sometimes when we leave organizations, staff sometimes don't even share the information about where they are going. I think we know that sometimes we choose to keep our next destinations secret, and it's obviously not incumbent on your employer or your previous employer to be able to establish where you are going unless it requires them to provide reference, or if you actually provide it in good faith. The other thing, of course, is if you insist on it, you may actually lose some institutions that would be a good source of business, who are not willing to make those commitments, but who have staff who are earning good salaries and who would like to access salary loans from you. So for a financial institution, it's really about striking the balance of how much risk am I willing to take versus how much information the institution is willing to give me, and then to make a decision whether the absence of that information is sufficient for you not to do the lending. But if it is, you believe that there's too much risk, then obviously you wouldn't make the loan. But it's really just striking a balance between how much risk can I take, how robust is my own monitoring system on these borrowers so that I can rely on it instead of relying on the employer. But Godwin is right that institutions suffer with tracing borrowers after. But I think in the case of unsecured loan, the bulk of the burden sits with the institution in the information you're able to extract from the borrower at the time they're taking the loan, so that it gives you some room for traceability, but also in your relationship with the employer, such that they can give you more information than they would give the next person. So balancing those two things would allow you to then perhaps manage the borrowers that come from that institution better.
All right, thank you, Paul. There's one more from Ronald Mutebi. Hopefully this is the Kabak of Uganda. He's talking about the high interest rates in Uganda compared to other markets. And he's asking, what are the banks doing to make loans more affordable for sustainability?
I don't know whether it's me who is to take this.
You could help
but
out.
I can take it.
Okay.
I think the interest rate issue is a big debate. I don't think that, I think the common answer that I like to give, which is what it is actually, is that interest rates are based on many things. In the case of financial institutions in Uganda, if I would just break it down for you into maybe five categories. One is the first thing that goes into interest rate is, where do you get your money from? You who is going to lend, where do you get your money from? So banks don't have a source of money other than the public, either the banking public or institutions. So you either have deposits or you borrow money from an international institution. And I'll just say borrowing from an institution, okay? So that is the first thing. Now, in each of these cases, there is a cost. So if I'm borrowing from the public and it's a current account, maybe I don't pay interest because that money is available to you and me. I can put money in the morning and I take it away in the evening. The financial institution cannot rely on that very much for lending purposes. However, if I took a fixed deposit, if I took out a fixed deposit and I negotiate with the bank will probably give me 10% interest. That will go into the cost that they will eventually give the borrower. The same thing will happen if they borrow money from an international institution. If you go to NSSF and borrow money, if you go to the European Investment Bank and borrow money, they will lend it to you at a commercial rate. So you probably charge you also 10 or 12%. So that is the first part of the interest rate equation. The second part of it is the cost of doing business in Uganda, okay? And that's where the comparison with other markets may come in. So what's the cost of doing business in Uganda? I have to open a branch in a location where the customers will be. That branch must have everything. It must have an ATM. It must have a bullion van. It must have staff to run it. It must have power all the time. It must have internet. It must have all the services that are supposed to make sure that the branch works. So there's a cost to that. That's attached again to the rate that eventually finds itself to you. The third part is there is something that comes out of the risk that we've been talking about the whole day. When you, if I just give an example, at the end of, I think at the end of September, the overall non-performing loans rate for the financial industry, for the banking industry in Uganda was about 5.8%. What this is the number, is effectively the volume of your portfolio or your loans that are not paid, where people are not paying, they are non-performing. This is a cost because I've borrowed the money, I have to find it somewhere. So I have to take it out of my profit and I put it aside and know these people are not going to pay. I have to find a way of paying for it before I even go to security, or remember there are some who are unsecured so they won't pay. So that's a cost. So that's the cost of what I would call risk, the cost of risk of doing this business. So that one also goes into my interest rate. The last one, which I can then also talk about, is banking is a business. Any financial services generally is a business. So the person who invests in a bank, the shareholder, needs a return. So they will have told the managers of the bank, whoever the managers are, that at the end of the year, when you're giving me your report, I'd like you to give me a dividend of so much, or I'd like to give me a return on my capital of so much. So whatever it is, there will be a price there. So if I just went from the top, if I said we took 10% from the fixed deposits, the cost of business of the branch, even if I gave it 2 or 3%, that's already 13%. If I put your 5.8% from the cost of risk, that's already 18.8%. Then, assuming my shareholder is not asking for too much money, he might ask for 2%. That's already 20.8%. Now, I think you now see when you find 1 or 2% or 3% on your prime rate, that's essentially how your interest is defined. So how can we contribute as financial institution? One of the things that we are doing on our side as financial institution is to reduce the cost of doing business. That's why many of you have been encouraged to move to digital platforms. We are also moving to digital platforms, opening less physical branches. So by reducing that cost, we will eventually pass on that cost to you. How can you as a borrower contribute to reducing the cost? Try and help me to reduce the 5.8%. When I lend you the money, bring it back. Over time, if this drops to 3%, invariably I will pass on the cost to you. I'll pass on the benefit to you because it's my business. I want to lend as much as possible, but I can only lend to you when you are. Now, the one thing you might not know also is that the 10% that is up here in the borrowing cost, especially from international institutions, comes from their assessment of all these things that I've talked about. So when they're out there and they know that the banking industry in Uganda, the rate of default is 5.8, all that feeds into their pricing. So if we get all these things, these other things, the 2 to 4 right, I might just be able to get cheaper credit on the international market at 8 or 6%. Eventually, I will pass that on to you. So we all have something to do about that cost. For the banking industry specifically, the focus is on reducing the cost of business. So I encourage our customers who are out there, please use the digital channels that financial institutions give you. Teach yourself, be a digital alien, get onto those platforms. I'm sure, even just for convenience purposes, it will reduce your own cost of banking services. For many institutions I know, those that have enabled their customers to migrate to digital platforms, the cost there in terms of charges is even lower. So you'll notice that you pay less for internet banking or even just for using a mobile app than having to walk and receive money over the counter. So I would encourage all our customers that are out there that are listening to this forum to use those channels, and I'm sure over time we will be able to pass on the benefit in terms of reduced interest. Thank you.
Wow, that was awesome, Paul. That is very nice, very well handled. And I think this addresses you, Mr. John Sekaja, because you have a query where you're saying the CBR is dropped, but the interest rates never change. And then the bankers tell you CBR interest rate is not determined by CBR alone. That was your query, Mr. John Sekaja. And I think what Paul has handled addresses your concern as well. As we plan to do the parting shots, I see Simon Odeke has a hand. Do you want to type your query, Mr. Simon Odeke? I see you raised up your hand. Do you want to type your query so we can handle it? In the parting shot to our panelists, I'll only request you to take us through the future in the next 5 years. You know, reality is now here. COVID-19, you can never do a call like this and not mention the word COVID-19. It has changed the way we live, the way we do business, the way we network, the way we interact, the way we transact, and everything. What do you see this journey? The digital journey is coming up, everything is in space. What do you see the credit facility in the next 5 years? Where do you see us as consumers of credit facilities, but also the banks? Where do we see the journey taking us for the next 5 years? I'll start with Sarah. Take us through the next 5 years driven by the digital platforms.
Thank you so much. Looking at what has happened, the COVID-19 and everything which is in place, typically the way we do business will change. It will change because most of the banks now are closing most of the branches which they had and moving away from the type of branch network which they had to the digital platforms. Also, they are going more into the agency banking, where the bank necessarily doesn't have to be a very big building. It could be near you in your villages, and you can go there and access facilities and do all sorts of transactions. Ideally, they are passing on to the cost to someone who owns a shop or somewhere in the village. So I implore all our customers to look at the agency bankings as real banks and be able to transact from their locality in their area. Thank you very much.
Thank you very much. Thank you very much, Sarah. And Paul, over to you.
Yeah, I was going to say that I mean, here we are. I'm at my desk, and I'm sure so are many of the attendees. So you can imagine if we had to have this session in a conference room somewhere, it would have cost the sponsors money. I'm sure they probably spent a little less than they would have spent if this conversation was had in a conference room somewhere. I think that's what the future of the consumer of financial services will be. There is going to be, it has already started. Mm-hmm. I think that one is the biggest, the most visible thing, that there is a migration from physical channels to digital channels. As that migration happens, especially in more traditional markets, we exist in a more traditional market where customers still have the requirement to be able to see their banker when they're accessing products. That almost means that some branches will remain open, but they are, in some markets, they are fully digital banks where there's no interaction, no physical interaction beyond what is on the platform. But it's the future also. So there'll be physical migration. There'll be migration from physical channels, no doubt about that. It's already happening. It's just going to intensify, especially COVID has brought it further forward than we had expected. The other thing that you're going to see is you're going to see a lot of partnerships. Banking as we know it now, in another 3 or 4 years, probably won't be there, because your typical transaction type products, your typical loan products, especially the smaller ones, the less complex ones, will increasingly be offered based on the data that we have about our customers. So we will access the tools that now technology provides to us in terms of artificial intelligence, be able to, after keeping your account for 3 or 4 years, be able to know that Silver has these needs, and then I can make you an offer from time to time without even waiting for you to come to the bank to ask for those. So I make you those offers, you accept them digitally, I make the money available to you. I have enough information, either from the bureaus or from the national ID registry, to be able to keep track of you. So I don't even need to physically know where you stay. As long as I have access to that data, it gives me comfort to lend you. Mm-hmm. You'll also see partnerships with other non-financial players. A lot of people who do services for payments, or what people call value-added services, will increasingly come into the financial space. So instead of, just for argument's sake, MTN building a bank of their own, they will partner with the financial institution to deliver certain products. The financial institution provides the money to finance a product. On the other side, a technology product or a telephony product. So you see a lot of those partnerships. So that's the future. And I think we just, as financial institutions, have to prepare ourselves. But I think it's particularly exciting for customers because it will mean less cost in financial services, significantly more convenience for customers. That would be my thought on the outlook.
What a wonderful way to close this. Very optimistic for the future, and we look forward to be part of the future. At this point, I wish to thank our very, very great audience who have been with us, sacrificed your lunch hour to be with us throughout this call. And many thanks to our strategic partners, Bank of Uganda, Uganda Bankers Association, Financial Sector Deepening Uganda, Uganda Insurance Association, and the Summit Consulting Limited. Our platinum sponsors, Bank of Africa, Uganda, very much thank you so much for this, and other sponsors. Finally, to our panelists, the level of knowledge you've provided to the audience today is awesome. I congratulate you for having done your very good preparations, bringing very much insights to this platform and creating this much awareness that we need for the sector to move forward. And a big thank you to the Uganda Institute of Banking and Financial Services for thinking through this Banking and Financial Services Awareness Month. There are upcoming webinars, upcoming calls throughout this month to conclude the Awareness Month. We have 3 more to go. We have the insurance, which is coming up very soon. We have one on insurance as an enabler for business growth and continuity. We have insurance as a tool for business survival, and the early planning for a happy retirement. We still have some very good mix on the menu that is coming up during this month. And we thank you so much for the Institute for preparing this. And on behalf of the Institute of Banking and Financial Services, again, I wish to say thank you to our audience, and hopefully we just keep the candle burning and we keep moving forward as we discuss this credit journey as we are growing our banking sector. From me, I stay Silva Sheine from Pride Microfinance and wish you a happy stay and say bye-bye.
Your money can enable you to live a better life only when you budget and save before you spend. Act now. Learn how to manage your income and expenditure correctly at the Banking Financial Services Awareness Month. Meet the financial experts. Learn how to deal with financial hardships like those caused by COVID-19. Be money smart. Be part of the Banking and Financial Services Awareness Month. Visit www.yourmoneycan.or.ug. Brought to you by the Uganda Institute of Banking and Financial Services, UIBFS.